And welcome. Really appreciate you joining with us tonight. There's several things we're going to do here on the front end to try to help give you a broad perspective of what's happening, particularly in the tax content on the CPA exam. And let's start with looking at pass rates, okay? And the pass rates are here for all 6 sections of the exam for 2025. Tonight we're mainly focused on REG tonight. We're going to talk just a little bit about TCP, but the good news is, notice the average pass rates on REG for 2025. You look in the right-hand column, 63%, and for TCP, it's over 77%. So far, those who are taking the tax parts of the new CPA exam, CPA Evolution, are doing really well. You might notice that. FAR and VAR is where the lowest pass rates are. And of course, when you're looking at your discipline exam, you can pick BAR, ISC, or TCP, and you can see there is quite a variance there in the pass rates. Also want to, at the beginning here, just give you a little bit of advice on a study plan. I'm assuming the reason you've joined us tonight is because you want to be a CPA, and that's a great goal to have. Having a CPA is great branding for you to have, whether you work in public accounting or not. That doesn't matter. Having the CPA brand is going to do great things for your career. And so we're here to help you pass the exam. And so I'll give you some study tips on passing the exam. First of all, don't wait till the last minute to schedule your exam. You want to try to make sure you pick a date that fits your personal calendar well, and make sure you got enough study time. So make sure you do that as far in advance as you possibly can. If you're working in public accounting, you want to give yourself some time after busy season ends before you take for the exam. Make sure you also create a study exam that's realistic. You learn best when you are studying in short segments. In other words, if you were to study, say, 5 hours in a row on a Saturday afternoon, and you contrasted that with studying 1 hour a night, Monday through Friday. So it's 5 hours both ways, but I can guarantee you're going to learn a whole lot more if you're studying 1 hour at a time for 5 times, because your brain's a muscle. And just like your muscles, when you exercise or run or swim, they get tired. And so those short study sessions can actually be very, very beneficial to you. Make sure you stick to a consistent plan, and you need to be trying to make sure that you're eating well and getting rest as you prepare to take the exam. Also, don't fall into the trap of keeping going back and studying the sections that you do the best on. That's our human nature, right? We'd rather get a 85% than a 60%, but you need to really focus on, you need to really decide what are the areas I'm weak in, and make sure you're focused on those. And make sure that you're looking at why did you miss the things that you missed. And then this brings to the last tip for your study time. And this is the most important one, I feel like. Notice it says practice, practice, practice. You cannot, when you're taking the CPA exam, you are going to be solving problems. And you're going to be solving problems you've never seen before. So how do you become an excellent problem solver? You don't get to that level by watching me or other people work problems. You do not get to that level by reading solutions, because when you're taking an exam and that question pops up, guess what? There's not going to be a solution for you to read and then mimic. So the only way to get ready for this is you've got to work problems yourselves. Work the problems yourself, okay? When you get to those TBSs, don't just read the solutions. Those take a while to work through, but make sure that be self-disciplined, and make sure you're practicing those yourself. And don't just watch the videos. Okay, that's a good start, but you got to work the problems also. So at this point, Suzanne is going to talk to you some about the task-based simulations.
All right, thank you very much, Greg. So TBSs, right? You might have heard a lot about these. Maybe in your classwork, you've been introduced to some task-based simulations. They do test the higher level learning skills. So we need to focus on our ability to take content and apply it, right? So application of what we're learning. And it's testing your ability to solve problems and to use critical thinking when you're going through these different task-based simulations. So they could come in a variety of formats. So it could be that it's in the form of looking at source documents. You could have charts and memos and emails and W-2s and divorce decrees and other types of documents that you have to sort through. And typically they could come in a format where either you're going to make an entry into a data entry box, or there's going to be a drop-down menu. My tip is always to make sure that you've entered an answer in every box if it's data entry. If it's a drop down, don't forget to hit accept. So when you select an answer, that you select it and then you hit accept. And then also it could be a research TBS. Now those have changed a little bit. We don't have time to get into the full discussion of a research TBS, but that's a different type of TBS that you could see. You could be working with spreadsheets. It could be looking at accounting literature. You're going to have to possibly respond to diagnostics. It really depends on the type of TBS that you get. What's important with TBSs, it's 50% of your score. So I know a lot of us focus on the multiple choice questions, but those TBSs can take you some time, but they're worth 50%. So we want to make sure that we're good at them. So there's going to be 8 TBSs in total spread over 3 testlets. So there's 5 testlets and 3 of those testlets contain TBSs. Now you are kind of looking at that testlet and figuring out, well, how many TBSs do I have within a particular testlet? Because if there's only 2 TBSs, it could be that they're more detailed and there's more source documents that you need to follow, or more exhibits that you need to take a look at and review and make a mental note of. If you've got 3 TBSs that are being provided, it could be shorter in length. Now, this does not indicate level of difficulty. I have seen very difficult TBSs that only had maybe 1 or 2 exhibits that I needed to review. So it really kind of depends. Time management. Pay attention to your time. You kind of when you open up a testlet, kind of open up the different TBSs and see what's being asked of you. Just quickly evaluate how much time you think it's going to take for that particular TBS. And then again, it says make sure to select an answer before leaving that testlet. We don't want to lose or leave any points on the table simply because we didn't answer a question. We're going to continue getting a lay of the land. So what does that mean? So paying attention to the structure. Again, how many exhibits do we have? What's the length of each question? What does that question stem look like? What are they asking for in that particular thing? Could be formatting. It could say that, if the answer is 0, make sure you answer 0. If you have to put an X, then you're going to put an X. If it's a negative number, you want to put a negative number. So make sure you do look at those formatting instructions carefully, again, so that you don't miss any points just by making a mistake there. It could consist of a series of drop-down menus and number inputs, and so you're paying attention to that. They could be asking you to do a tax form. So it could be an Excel spreadsheet that maybe looks like a Schedule A for itemized deductions, and so you're entering those applicable, those appropriate numbers in there. So it could be one tax form, multiple tax forms. Next slide. Reviewing the exhibits, again, we want to kind of get a lay of the land to see what's being offered to us. This takes practice, guys. That's why when Greg said practice, 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 yes, you definitely need to practice, because you're like, for example, where it says divorce agreement, what are you looking for in that divorce agreement? Well, the date, all right, alimony, child support. So we got to kind of make a mental note of what it is that they're looking for. Don't lose sleep over subtotals. So in TBSs, it's not like a multiple choice. TBSs, you might, again, Schedule A, they're asking you to do a Schedule A and you get one thing wrong on it, but everything else is right. They're going to grade that accordingly. Document review simulation. You might not be familiar with this type. This is where they're giving you a document or a table. The ones that I've seen here recently are undocumented. It's like an email, and there's lines on that email that you're reviewing to see if they're correct. And if you think that it's incorrect, there's going to be a drop-down menu, and then you're selecting the correct response. And so you're skimming over the questions. You're looking to see if there is a calculation involved, but there more than likely might not be. And then you're just going ahead and answering those questions. Sometimes it's best to work backwards, right? Look at the answer choices and then work backwards to see what would be the best choice for that particular TBS.
Okay, thanks, Suzanne. One other thing just about TBSs before I talk about the new tax law changes. You know, one thing to remember is the multiple choice questions and the test-based simulations, they're both being tested. They're both covering the same tax law, right? It's the same law that's being tested in both areas, just being tested in different ways. And so once again, as Suzanne emphasized and I did, the only way that you really get proficient at working those TBSs is to work as many as you can. Now, what I want to do, I'm going to take about 5 minutes here, and I'm going to talk about some of the recent changes that were made because of the tax bill that was signed on July 4th of 2025. So sometimes this is called the One Big Beautiful Act. Sometimes it's called OB3. Actually, the official legal name for this tax bill is House Resolution 1. Now, listen to me very carefully about timing on this. If you are taking REG before July 1st of 2026, all of the changes that are in that tax bill are not being tested. They're not being tested. They will not start being tested until July 1st of 2026. So why am I going to quickly mention what the most important changes are from that tax bill? It's because many of these changes actually took effect in real life January 1st of 2025. And the rest of them took effect January 1st of 2026. So here we are in near the end of February 2026. So really all these things that if you're working at a public accounting firm right now, you're actually dealing with these changes on a day-to-day basis. And so I want to point out to you what these items are so you'll know that, hey, when you're studying UWorld and you don't see something in there mentioned about a deduction for overtime, it's not because UWorld's made a mistake. It's because they're not testing that yet. All right. So that's what I'm going to cover for you very, very quickly here. So let's jump into these. Now you're going to see on the slide deck that there'll be several things where it said that the new tax bill made something permanent that was already in the law. So if that's the case, that's still being tested, right? Because that was already in the law in 23, 24, 25. The law just made it permanent. But if you're familiar with what's known as Section 1202 stock or qualified small business stock, there's changes made there, not tested. There's a new deduction for seniors who are 65 and older that you may have even seen a lot about that in the popular press. Not going to be tested until July 1st of 2026 and after. The deduction for tips, the deduction for overtime. There's a new deduction for auto loan interest if certain conditions are met, up to $10,000, not being tested. Now, one thing I want to mention to you is I think that, and the AICP hasn't said this for sure, okay, but for example, are you likely, if you're taking the exam in May of 2026, are you likely to see a multiple choice question that asks, can you deduct interest on your automobile loan? So I think the AICP is going to stay away from those questions. Why? Because the correct answer to that under the 2025 law is no, you can't deduct it. But as y'all know, if you're doing tax work right now, you know in real life, it actually is deductible, okay, starting January 1st of 2026. So I don't think they want to put you in a situation where you have to actually provide an answer that's incorrect based on the real law because they're not testing the real law yet. You see what I'm saying? So I think during this transition period, they're going to stay away from these types of topics. The limitation on state and local taxes, okay, that's capped at $10,000. that increase, but that's not being tested yet. There's a new overall limitation on itemized deductions, will not be tested until after July 1st of 2026. There was a small change to moving expenses. The excess business loss limitation, that was just something made permanent. So what you would have learned in your university courses about that with related to excess business losses, okay, that will be being tested, because all it did was make what you already knew permanent. The QBI deduction, that's been around since 2018, so that is testable, but there was a few changes made to that by the new law, a minimum deduction of $400, and they extended the phase-out ranges. Those new changes are not going to be tested. ABLE accounts, once again, those have been around for a while. There were some tweaks made to those. Any of the new tweaks are not going to be tested yet. Section 529 plans, the new tax bill broadened significantly the types of expenditures that can qualify to be tax-free when they're made out of a 529 plan. But that increased breadth of expenditures, they'll start testing that in July. Next, the estate and gift tax exemption, they did increase that somewhat from what it would have been if we did not have the new tax bill. But that's indexed for inflation, which brings up another really important point, is anything that is indexed for inflation in the tax law, you do not have to memorize for REG or TCP, no matter when you're setting for it. If it's indexed for inflation, they're going to provide you with those numbers, because they don't want you wasting your time trying to memorize numbers that are going to change every year anyway. The child tax credit, once again, yes, that's testable, but the increase in it to $2,200, that's not testable yet. The credit for other dependents, that has stayed the same. That was made permanent by the new tax bill. Child independent care credit, once again, that's been around for a long time, but they increased the percentage that you can use to compute that credit. But that's not testable yet. The adoption credit, they've made that refundable. If you've heard that somewhere, that's great that you've heard it. It's great for those who are adopting, but the refundability is not going to be tested until July 1st of 2026. Dependent care assistance programs, you can see they increased that amount a little bit from $5,000 to $7,500. Some important changes to charitable contributions for individuals. They can now only deduct those to the extent they exceed 0.5% of their adjusted gross income. And also, if you don't itemize, you actually now can take a charitable contribution of up to $1,000, but those will not be tested yet. Moving ahead here, gambling losses. You may be aware that you can only deduct gambling losses to the extent of gambling winnings. Well, starting in July, on the exam, you can actually only deduct expenses up to 90% of your gambling winnings, but that will be not tested until July. I already mentioned the above line deduction for charitable contributions. There's a new thing called Trump accounts. Anything that you see about Trump accounts, don't worry about it until you get to July 1st of 2026. There's a lot of energy credits that were repealed. So like if you went out and bought a Tesla and you get that $7,500 credit, but that was repealed by the new tax law. Okay, so that repeal is not being tested yet. The bonus depreciation, now that's a big deal, right? Bonus depreciation was being phased out. So bonus depreciation was at 40% for 2025. That's what's going to be tested, 40% bonus depreciation. Right now, it's the increase back to 100%. It's not being tested yet. There's also 100% bonus depreciation on something known as qualified production property, not testable yet. Section 179, they just increased these amounts a little bit. And those are indexed for inflation anyway, right? So they're going to give you those numbers if you need them. Research and experimental expenditures under the law, you're going to be tested under. Those have to be amortized over 5 years. But under the new law, you can expense them immediately. Okay, but for what you're taking, they're going to be amortized over 5 years if you're setting before July the 1st. The changes, the limitations on business interest. They did change how you compute the amount of adjusted taxable income that you multiply by 30% to limit your business interest, but that change will not be tested yet. Made a few changes to the Form 1099-K reporting standards. If you're familiar with what's known the CHIP credit, the Advanced Manufacturer Investment Credit, they've made that a little more attractive by increasing the percentage from 25% to 35%. And just like they made some changes to charitable contributions for individuals, they've also made some additional limitations for corporations. They now can only deduct charitable contributions to the extent they exceed 1% of their taxable income. But once again, you're not going to be tested on that unless you test after July 1st of 2026. Employer provided child credit. They made this a little bit more attractive also by increasing the percentage from 25% to 40%. And that's it. So I don't know if I did that in 5 minutes or not. Probably not. Probably took a little bit longer. But once again, I'll be honest with you. We debated whether or not we wanted to go over those because you're not being tested on them. And you might be wondering the same thing. But we thought we wanted to get that terminology out in front of you. Okay. Because once again, as I said, when you're actually studying the material in UWorld right now, don't want you to think that they've left important things out that you need to know, because they haven't. All right, Suzanne, over to you.
All right. Well, we had a question, Greg, about, it says, we all know that REG and TCP are overlapping each other. Is it still ideal to take REG before July 1st and TCP after? I responded with, I think that it's still best to try to take REG and TCP before July 1st, before the changes take effect. I know that it's a lot of material, but for you tax geeks out there like us, once you're studying tax, let's just go ahead and get on a roll and try to pass both sections. Right now, the pass rate for TCP is extremely high. Greg, do you have a different opinion on that?
No, I agree with you if you have enough time to study for both of those. Okay.
Yeah.
But I would, if you're planning on taking TCP for your discipline exam, I would take it as soon after you finish REG as you possibly can. And if that does push you past July the 1st, then once again, I summarize those things in 5 minutes. I mean, you can absorb those things, but I agree with Suzanne. If you can get them both in before July 1st, that would be preferable.
Yeah. So typically it'll take you about 6 to 8 weeks to study for a section, right? So if you're figuring out, when can I schedule the exam, you can do it even if you're currently in public accounting. You're just going to need to be diligent with your studying. All right. So we just want to take about 5 minutes to talk about some of the TCP topics. Again, if you're really into tax like Greg and I are, this is, that if we had to do it over again, right, we would be launching right into REG and we would then be taking TCP. So I just wanted to go over briefly the different areas with the TCP topic. So there's 4 different areas. Area 1 is looking at tax compliance and planning for individuals and personal financial planning. Now, some of us are maybe not as familiar with the personal financial planning aspect. All right, so that would be something that you're going to need to learn and really go through that UWorld material. I will say UWorld really presents the solutions in a readable format, just very comprehensive, good illustrations to help you understand the concepts, whether it's REG or TCP. So the first one, it says individual compliance and tax planning considerations. So some of the topics are equity compensation, AMT, foreign earned income, kiddie tax, FSA versus HSA, donating non-cash charitable contributions. Part B, compliance for passive activity and at-risk loss limitations. Again, looking at that calculation of at-risk loss, passive loss activity, loss limitations, and the use of suspended losses. C, gift taxation, compliance and planning. Just recalling, being able to calculate the amount of taxable gifts, the allowable gift tax deductions and exclusions for federal tax purposes. And then D, the personal financial planning for individuals. Make sure that you can demonstrate an understanding of the advantages and the disadvantages of the different types of pension plans that you can have, how to mitigate risk, also looking at return on investment. All right, so area 2 is now focusing on entity tax compliance, and you can see our areas here. Now, if you're looking at for C corporations, some of the topics that are being highlighted for TCP are net operating and capital loss utilization, transactions between shareholders and C corporations, international tax issues, and a little bit on consolidated tax returns. In S corporation, need to be able to understand basis, right? How to do the calculation of basis. And then again, transactions between the shareholder and the S corporation. Partnerships, again, focusing on basis. We have to understand the transactions between a partnership and that partner, working with guaranteed payments, understanding any types of ownership changes and distributions. And then trusts and tax exempt organizations, again, looking at the identification of the different types of trusts and looking at tax exempt status and looking at unrelated business income. All right, then we're moving on to entity tax planning, only 10 to 20% here. Again, you got 4 different sections under this area 3. So formation and liquidation of business entities. Now, this could be across multiple entity types. So this is where you really kind of need to know the pros and cons of each of your entity selections to see if that's an advantage or a disadvantage and how that would play. So, formation under section 351 or a liquidation, and then make a comparison of C corps, S corps, partnerships, and so on. Area 3 for tax planning for C corporation, again, utilization of those NOLs, capital loss carryovers, looking at business expansions, calculating estimated tax payments to make sure that we can avoid any types of penalties. And S corporations, built-in gains, terminations, distributions to shareholders, and then finally for partnerships, contributions to the partnership with non-cash property, guaranteed payments, non-liquidating distributions. And then finally, our area 4 is looking at property transactions. So our non-taxable disposition of assets are basically focusing on calculating a realized gain, recognized gain, when you would have a non-taxable disposition like a like-kind exchange or an involuntary conversion. Amount and character of gains in that next part there, focusing on section 1231, section 1245, section 1250, and understanding disposition of small business stock under 1244 and our installment rules. And then finally, related party transactions. Can you calculate the direct and indirect ownership percentages, as well as calculating the gain or loss and any imputed interest on related party transactions? So again, just a brief overview of our TCP topics. All right, so I'm going to continue our discussion here. Again, an overview of some of our selected reg chapters that we're going to be going through. This is not meant to be comprehensive of every single chapter. So let's go ahead and get started. Greg?
Hey, Suzanne, can I jump in for just a minute? So
Sure.
Got a question on, are the exams going to be more difficult? And they said specifically they're studying for auditing now, but and when you say more difficult, I guess you're probably talking about compared to what the exam was before 2024, before CPA Evolution. Mm-hmm. And to be honest, I don't think they're more difficult. The blueprints that they've given us are much more detailed and specific, so we got a better sense of exactly what they're testing. And so in tax, I definitely do not think it's more difficult, because under the old testing format, you were responsible for everything that's in reg and TCP in just in regulation. So you had to study all that, and now it's kind of split up into 2 parts. Now, as I showed you, the FAR and BAR pass rates have not been extremely high. Auditing's been pretty high, but in general, I think auditing and tax, it has shown that it's not as difficult. Financial and BAR, it's about the same difficulty as in the past. Okay, Suzanne.
All right, let's go ahead and get started. Next slide. All right. Again, next slide. All right. We'll be looking at a chapter dealing with basis of assets. Now, most of us are familiar with this, and that if we make a purchase, that we have to figure out the cost basis of that particular asset. What we want to focus on here is how do you recover basis? And you can only do it once, right? So either you're going to expense that asset if you're allowed to, or capitalize it and depreciate it or amortize it if it's an intangible asset, or eventually you're going to sell that asset and you're going to recover that basis. Here is a detail of tax basis for a purchased asset. So again, you probably have seen something similar to this in previous academic work that you've done at your university. I just wanted to point out for shipping, FOB shipping point, all right, not FOB destination. FOB shipping point is included in our basis. And then also testing fees, which I wanted to talk about on the next slide. So you have costs that you have when you are purchasing the asset or you are making it ready, all right, to place it into service. And you can see some of them that are listed here. But then you also have that in-service date, and then some of the costs that you might incur after you've placed that asset into service. And so when I think about testing, so it could be that you've purchased something, new machinery and equipment for your manufacturing plant, and you have testing, rightfully so, that you want to make sure that everything is ready to go, right? Before you flip the switch, right? And turn it on. So you could be paying for testing fees before you place it into service. And then that would go into the calculation of the basis. But anything that's after that, testing after that, because you might have routine maintenance, routine testing that happens every 6-12 months. That is going to be a current cost under repairs, maintenance, and operating costs. All right, so we've got our tangible assets, our intangible assets. So tangible assets, including realty, which is just our land and buildings. Personalty is any other tangible asset. And then our intangible assets that lack physical substance, but they do provide an economic benefit. We do have a de minimis safe harbor rule. This is a really good chart that UWorld has put together here under section 263, that if you you identify the cost of that particular asset that you acquired, all right, or you produced, and then it's asking you, do you have an applicable financial statement? And so that just means briefly that you have an audited financial statement. And so if I do have an audited financial statement and I've elected this safe harbor, I go to the left part of my screen here and I can expense property costing up to $5,000. Now I need to be consistent when I do this. All right. If you make this election and you have audited financial statements, in order to be able to expense $5,000 for, particular types of assets. If you don't have applicable financial statements, then you're looking at $2,500. All right. Now this is dealing with, again, capitalized improvements. So if an expenditure is determined to be any of these, betterment, adaptation, or restoration, it's got to be capitalized. Now, the only one that can be sometimes a little confusing is the restoration. It says replace a major component of the property. I had to look this up myself too. Implies that a replacement of 40% or less of a major component may not be significant portion of a major component and would not be considered restoration. So you have to look at the details of these, but these are capitalized improvement costs. All right, let's talk about gift basis. All right, you receive something through a gift. Nice. Your uncle, your grandma gave you something. And we have two different bases that you need to pay attention to. It's called gain basis and loss basis. Donor's adjusted basis is equal to the gain basis. Loss basis is the lesser of the fair market value as of the date of the gift, or the donor's adjusted basis. When you turn around and you sell that asset, you need to pay attention to those sub bullets there. Okay. Because that will determine on how you recognize that gain or loss, or if not at all. Next slide. All right, if I receive something through inheritance, our general rule is that the beneficiary's basis is fair market value as of the date of death. The executor can elect to use an alternate valuation date, which is 6 months after the date of death. Pay attention to the holding period. It's always long-term for inherited assets. Next, yeah. Wash sales. All right. So if I have a wash sale, it just means that I sold a security at a loss within 30 days before or after the sale. So if I have that situation and I replaced it with substantially identical shares, that I'm going to have that the IRS is going to disallow that wash sale loss. And so instead, you add the loss to the cost basis of that new security. Next. All right. I wasn't too bad there. I'm a minute off. I'm trying to pay attention to my time. All right. Next, we're getting into cost recovery. So most of us understand depreciation expense and how it works. You need to know the following. You got to know the depreciation method, the recovery life, right? Or the depreciation convention. Next slide. So this briefly goes over what's called double declining balance. So we use MACR's modified accelerated cost recovery system. So double declining balance with a half-year convention. A half-year convention on tangible personality. You're looking at a half year's worth of depreciation in the year of purchase and a half in the year of sale. They've given you a couple of descriptions here for 5 and 7 year. This is just the chart that you would use to determine, which is very useful. All right, I could go through the math to prove this, but we don't have time for that today. All right, again, with personality, pay attention to, you got the half-year convention, but also if more than 40% of your personality is placed into service during the last quarter of the taxable year. All right, so if your calendar year, you're looking at October, November, December, if greater than 40%, all right, then you got to use the mid-quarter convention. For our realty, we use straight line depreciation with a mid-month convention. Residential is going to have a 27.5-year recovery period. Non-residential realty is 39 years. This slide's covering a little bit on qualified improvement property. All right. Improvements to the interior portion of non-residential real property. Got to be careful here on what's considered QIP and what is not considered QIP. So it does exclude structural changes, elevators, escalators, and building enlargements, but it does include renovations to lighting, plumbing, and interior walls. All right, Section 179 is a very taxpayer-friendly code section. It's an expensing election in which you are choosing if it's qualified property that you can expense it in the current year. So for this testing period, the dollar amount that you see on the screen is correct for the testing period up to July 1st of 2026. Next slide. Now, we do have two limitations for our Section 179. Again, there's only so much that you can purchase and place into service under qualified Section 179. Otherwise, that Section 179 expensing, that 1.25 million is going to start to get phased out. This reduction doesn't create a carry forward. And then finally, the business income limitation, right? So Section 179 can only bring you down to 0. Any excess does get to be carried forward to future years. Bonus depreciation, this is correct for the testing period right now up until July 1st of 2026. 2025, you're looking at a 40% bonus depreciation. Again, another taxpayer-friendly code section. It applies to new and used property. Now we got to be on how we use this. All right, order of the depreciation deduction. You look at Section 179 first, then you look at bonus, then you look at makers, right? So there's 3 steps actually to the process, possibly, and that is the order that you apply it in. A couple alternatives to makers. One I wanted to point out, ADS, right? Alternate depreciation system can be elected. All right. So instead you're using 1.5 declining balance or straight line. Luxury auto limits, these change every year for inflation. So don't think that you have to have this memorized. This is one of those things that Greg was talking about before. So you just need to be aware of it, right? So if it says automobile and it was used, 85% for business, and then you're calculating the depreciation expense on that, that you have a limit. You have limit rules on luxury autos for cars that are 6,000 pounds or less. For heavy SUVs, we do have a different limit for 2025. Just a little bit here on intangible assets. So yeah, goodwill, franchises, trademarks, covenant not to compete, some other ones that we can have amortized straight line over 15 years. Okay, so our next item is looking at gross income. Now, gross income is from whatever source derived, so it's very broad. We have a code section that defines that. Next slide. Most of it, nope, one slide back. Yep, thank you. Everything, all right, if you're ever in doubt, you're going to include it in income, right? So you have to have a code section that specifically says that you can exclude it in order to exclude it, right? So when we think of W-2, that's a pretty easy one. Income is not limited to cash receipts, though. It could come from other sources like property. Bartering is also, it could be doing fair market value of services. I provided a service, right? And then I received, right, a fair market value of services. You know, taxable income can differ from accounting income. Taxable income, we're looking at the Internal Revenue Code. Accounting, yeah, we're looking at GAAP. Constructive receipt for a cash basis taxpayer. Now, cash basis is pretty straightforward. I think we all understand that. You've been going over cash basis since you were in your first financial accounting course. You know, do I have the cash? Do I have access to the cash? But then there's this topic called constructive receipt. So do you have possession or control over the funds? Yes, then you got to report it in the current period. But if you have, do you have some restrictions on it? All right. Are you able to access it and use those funds? You know, if the answer is no, currently reportable in the current period, or no, it says substantial restrictions on the taxpayer's ability to access and use the funds. No, then reported in the current period. Otherwise, reported later. Couple of different rules. Assignment of income, fruit and tree doctrine, right? If I earn the income, then I should be taxed on it. Tax benefit rule. If you've taken a deduction in a previous year for something and then you receive a refund or a reimbursement of some sort that in a next year, then to the extent that you receive the benefit of that deduction a previous year, then you got to include it in income. Examples include medical expenses and state and local taxes. Rental income, again, most of us think that that should be pretty straightforward, right? That rental income is includable. Prepaid rent is taxed when received, even if it is for last month's rent that's going to be 11 months from now. All right, so prepaid rent is taxed when received. Lease deposits, got to pay attention to the wording. So is it a security deposit? You know, what is it? You know, is this an item that's being paid that I potentially am going to have to, you know, give back to my lessee? All right, because if that's the case, then I'm not going to include that in my income. Next. So fringe benefits, great, right? Employers use this all the time to incentivize employees or new employees to come work for them. Fringe benefits can either be taxable or non-taxable. Non-monetary compensation for services performed. On this slide, you see some examples of taxable benefits. And on this slide, you see some non-taxable, some excludable benefits that are included here. And you can see that there's a long list. Next. Moving on to group term life insurance. So very nice. Once again, if your employer provides this to you, it could be that they are offering a group term life insurance policy on $50,000, face value of $50,000. That the premiums that are being paid on your behalf excludable on the first $50,000. For amounts over $50,000, then we're going to be looking at a table that's based on your age, right, to determine how much of those premiums would need to get included in your income. Next. Employee discounts are nice, right? No additional cost services. Like if I'm flying standby and I work for an airlines, different types of discounts limited to the gross profit percentage or 20% of services. De minimis fringe benefits, your company, right? Your employer might offer free pop or snacks or something like that. Payments for transportation and parking, that dollar amount changes every year for inflation, so that would have to be given. Now we do have some rules, right? It can't be, these fringe benefits cannot be discriminatory. So we do need to kind of be familiar with those rules. You can see in the middle bullet there, it does not apply to the following fringe benefits. And that's because these types of fringe benefits would have been deductible anyway if you were self-employed. Next. Interest income, that's pretty straightforward. Most interest income is includable. All right, you have to report that and pay tax on it. State and local municipal bond, not taxable, tax exempt. So look for that. Now, it might not say muni interest income on there, right? It might say City of St. Charles or State of Illinois, right? So look for that wording that indicating to you that it's a municipal bond and then the interest would be tax exempt. Series EE bonds, very attractive for parents to purchase this for their kids or grandparents. And if it's redeemed and used for higher education, possibly then the interest portion on that is going to be excludable. Dividend income, most of us understand that, yes, that is includable in income. More than likely, you'll get a 1099 DIV, and it's indicating to you the ordinary dividend portion and the capital gain portion. So we need to pay attention to that, ordinary and qualified dividend, which is treated as a long-term capital gain and gets taxed at a rate of 0, 15, or 20%. Following is not taxed as dividend income. So a life insurance dividend, so it's just the return of the premium. All right. The interest on that would still be taxable, but the life insurance dividend that is treated as a return on premium. So not stock dividends or a stock split. I have 100 shares, it splits. Now I have 200. That's not a taxable event because you didn't sell it, right? All you're doing is changing your per share on that basis. Distributions from retirement plans, you want to be familiar with those, the different types. It says an employee has basis to the extent that the employee made non-deductible contributions. Now, the following does not create basis: contributions made by your employer, tax deductible contributions, and then the earnings inside that plan. A little bit more information: distributions from traditional IRAs are typically taxed as ordinary income. We want to try to take those distributions after age 59 and a half so that we're not subject to a penalty. I do have a slide in here that indicates some exceptions to the rule. Qualified distributions from Roth plans are not taxable. The contributions themselves were not deductible. We treat this as ordinary income. All right, so here's some of the exceptions. So you don't want to be subject to that 10% penalty. So it's not imposed if you're disabled, age 59 and a half, separated from service after age 55, or if you died. And then also for some of these other items here that are listed, those are some also other exceptions. Annuity just means a string of payments over a period of time. And so you have some money and you invest in this annuity and you are hoping that you are going to outlive the annuity, right? Because you're purchasing it typically with post-tax dollars and you're hoping that you're going to get a good return on your investment and that eventually that they're going to be giving you payments each year. And so you're determining, all right, by this ratio, the investment in the annuity, what did I pay for it, divided by the expected return, which would be based on life expectancy. All right. So you probably need some help with that. And then multiply by the payment that you're actually receiving to determine what's excluded. Obviously, the difference would be included in your income. Injury award, unfortunately, you were injured in some shape or form, you sued, and you're receiving a payment. And so you're trying to figure out, well, what do I do with this payment? Well, it depends, right? Whether it's includable in your income or not. Is the payment due to a physical injury or illness? If that's the case, then it's not taxable. If the payment received is due to a non-physical injury or illness, it is taxable. So like libel, slander, discrimination, all right, those types of payments you would have to include in income. I do want to point out punitive damages, always, always, always includable. Last bullet, income from wrongly incarcerated individual. That's always going to be excluded. Gifts, inheritances, treasure trove. So the gift or inheritance itself is not taxable to you, no matter the dollar amount. I could receive an inheritance of $1 million, and that's not going to be taxed to me. If I take that million and I invest it in stock and it's starting to generate dividend income, well, then the dividend income would be taxed to me. Treasure trove principle is looking at if you find something and now you have unrestricted access to it, it has increased my wealth. So therefore, those found items are included in your taxable income. All right, character of assets, just three categories here: ordinary, capital, and Section 1231. Be familiar with these definitions. I don't have time to go through them in detail, but it's very important that you do understand the difference. Multiple choice questions here, definitely on this. And then on a TBS, they could also be asking you to calculate that. So ordinary, you're looking at inventory and receivables typically. Next slide. Section 1231, an asset used in a trade or business and held long term. So typically your depreciable tangible assets, realty used in a trade or business. Pay attention to whether you have a net 1231 gain or a net 1231 loss. You're going to want to know the difference between those two. Capital assets is just anything that doesn't qualify as ordinary income or Section 1231, but typically you're looking at your investment assets and your personal use assets. As individuals, we're limited to a net capital loss of $3,000 per year. Get familiar with the holding periods because that will be important in calculating those capital gains and losses. Skip this one. Worthless security date. It's treated as a worthless security as of the end of the year, which is important for holding period purposes. Remember, you're not determining whether it's worthless. All right, somebody else is, but the holding period, it's deemed worthless as of the last day of the year. Net capital losses. So you've got some capital losses and you're trying to figure out how to offset them against capital gains. Maybe you've got 10 transactions that year, right? There is an order. You take your you take your capital loss and you apply it against your 28%, then your 25%, and then your 15%. That 15% circle could be 0 or 20. It's 0, 15, or 20. Certain awards, typically the fair market value of those items are included in income. You can exclude it if it's for civic, artistic, educational, scientific, or literary achievement. Think Nobel Peace Prize. Next slide. Debt forgiveness. The general rule is that debt forgiveness is includable in income. We do have some exceptions to the rule if you are considered bankrupt or insolvent, or if it's a student loan that's being discharged because of death or disability, that's also excluded. Scholarships, all right, if you're receiving a scholarship, you're a degree-seeking student and it's being used for tuition and fees and qualifying expenses, that it's excluded. But if you get a scholarship for room and board, it's treated as earned income. Life insurance, all right, proceeds on life insurance policies received due to death of the insured are excluded. Unless you have a specific, if you're terminally or chronically ill and you've accelerated those death benefits, that could be excluded. Next. All right, just quickly on Chapter 13, dealing with pass-through entities, right? So the entity is not being taxed, but the shareholder or the partner is. So with a partnership, what's important here is determining the difference between ordinary business income and separately stated items. Lots of good multiple choice questions on that, or a TBS even, where they're asking you to calculate ordinary business income. Make sure you understand how distributions from partnerships are treated as well. Next. Here's just some examples of separately stated items for you to review later. Next. Guaranteed payments. So you've made partner, congratulations. But now you're like, well, how do I pay my bills? And so you are still performing services for the partnership. So you receive a guaranteed payment. You also could receive a guaranteed payment for the use of partner's capital. It's deductible. All right. It's deductible as an expense by the partnership on the return in determining ordinary business income, but it's ordinary income to the recipient partner and subject to self-employment tax for services. In order to take a loss on your tax return, there are 3 hurdles. Look at basis, at risk, and passive rules. Next. And then S corporations, again, we're paying attention to how income is allocated. We don't have the flexibility like partnerships do. Understand how distributions work and how to calculate our basis. S corp shareholders are not subject to self-employment tax. Okay, I'm a little long there. Sorry about that, Sarah.
No, I thought that was great. Thank you so much, Suzanne, and thank you, Greg. We've got a little intermission here briefly while I give some more information about the UWorld review course, and we'll be happy to take any questions that you may have. Okay, specifically, the 2026 review course, you can be confident that our review course is the most up-to-date, comprehensive review course on the market. You will be set to pass the 2026 exam with the UWorld course. And once the new tax law is released, or goes active on the exam, excuse me, that will be pushed out to you automatically. All of the UWorld courses are clearly mapped to the AICPA blueprints. So you will know exactly what you're going to be tested on and when you're going to be tested on. I'll get into that a little bit in just a few minutes. And we have the best instructors in the industry. All of that's going to equal out and give you a 90% chance of passing the exam on the first time. Okay, super proud of our rock star instructors. Some of them literally are rock stars in the CPA prep exam world, literally have trained and taught thousands and thousands of current CPAs and gotten them to pass the exam. So we really do have the best instructors in the industry. They're all CPAs, and many of them are staff and part of some of the best programs in the country. Next slide. Okay. Suzanne and Greg have both talked about this. You are probably thinking, how do I know when I'm exam ready? Well, UWorld has a 2-pronged approach to making you confident that you are going to be ready to pass the exam on exam day. The first is our interactive study planner. When both Greg and Suzanne referred to picking your test day, when you log into your UWorld course, one of the first things you're going to do is pick that day and put it into the system. One of the best practices here, you can go on to the next slide, Greg. One of the best practices is to back-end your exam or your study planner. So we ask that you pick your exam date somewhere between 8 to 16 weeks in the future. Stick to that date and then build out your study plan accordingly. You're going to tell us how many days a week that you can devote, or excuse me, how many hours a day that you can devote. As Greg mentioned, you really do want to touch this content and study every single day. It's going to be such a much more effective process. And our study planner sets that up that way. And then from there, you will build out a specific plan so you'll know what to do every single day. As I mentioned before, all of our courses are aligned specifically to the blueprint. So you're going to know exactly what you're being tested on, questions that you're being asked, whether they're going to show up as a multiple choice or a task-based simulation. This is really an exam hack that's going to make you comfortable and confident on exam day. Next slide. Okay, both Greg and Suzanne spent some time talking about the TBSs and how important it is to understand these. Like was mentioned, there are 8 included in the REG portion of the exam, and these are worth 50%. Suzanne hit it. I'm going to hit it again. So many students don't spend enough time understanding how to organize and work through these TBSs. What we have built, and we get great review and feedback on these from candidates, is that specific mastery videos that will walk you through step by step. Suzanne alluded to a lot of the key suggestions, but this, our mastery videos will show you step by step how to master the TBSs. So you'll be super confident and prepared. Okay, you all are attending a free boot camp, a live free boot camp, but what we offer within the course, if our live boot camps that are given throughout, often throughout the year. This is an interactive program that goes over difficult to teach topics within the course. You're able to interact with the instructors and ask questions live. So this is also a key feature of our review course. Okay, one of the biggest features, Greg was hitting on this thoroughly earlier, is UWorld's active learning component. You will not just sit and be watching videos and answering questions passively. A lot of resources and effort has been built, added to build the active learning component. You are going to get statistical data on each question to understand whether it's an easy question or it's a more difficult one that you'll need to spend more time on. And then you'll also get graphical representation to help you understand. And a key feature of UWorld that gets such great feedback from candidates is not only do we affirm when you get a right answer right, UWorld goes through and specifically lays out and explains in easy to understand language why each wrong answer is wrong. So you'll really, it's really going to help you understand the content. Okay, I mentioned the two-prong approach to know that you are exam ready. First being the study planner, which if you are an active UWorld user and you're not utilizing that, please start because it's really going to help you. And then the Smart Path. The UWorld Smart Path is the patented approach to making sure that if you follow our Smart Path, which is built into your course, which is hitting the specific number of questions aligned with the getting those questions right and working the same number of questions, you are going to be ready for to pass that exam on exam day. So it's the Smart Path and the study planner working together. Okay, the last couple of weeks before your exam day that you're going to pick and stick to, we recommend that you've worked your way through and you're finished with your study planner through the Smart Path, and you don't want to learn any new content then. So the last couple of weeks, though, what you do want to set up are a couple of mock exams or use our exam sims. The exam sims are available to you throughout the course. So a best practice is to work on those on a longer day, study day of the week. We usually recommend to do multiple hours on a Saturday or Sunday to get you ready to sit for that 4-hour exam. And then you also have access to mock exams, which we recommend maybe 1 or 2 of those. This is a whole new question bank set, all questions that you haven't seen before. You know, obviously you don't want to work on that a day or 2 before the exam, but 2 in the couple weeks prior to the exam are really helpful. Okay, all of that I just went through, this you're going to hit our 90% pass rate. And we're super proud of this. Again, this is based on the evolution, and you know, we've got lots and lots of that video there. In that last slide was one of our favorite recent passees. She actually was able to pass all 4 parts in a year and was excited and celebrating with her students. So, okay, sorry, go ahead, Greg. And we're thrilled that you all have been able to attend tonight. And because of your attendance, you get access to a special deal with UWorld. This is a discount off our already reasonably priced full elite course. You're going to get everything that we've talked about tonight, all access to all of the test banks and questions. You're going to get access to the study planner and the Smart Path that we talked about, the mastery videos, the live boot camps. We'll even offer you a hard copy of our workbooks, and they're not hardback books. They're workbooks that are designed to write out problems and work in as you're working in the course. So to get that discount, you just scan the QR code or use the code CPA webinar at checkout. And that, the next slide. Yep. So I'm going to hand it back. Thank you so much for your time tonight. I'm happy to field any questions about the course specifically, and I'm going to send it back to Greg for to finish us up.
Okay. Thanks, Sarah. You know, remember, if you're sending questions in up in the top right hand corner, just click on that question mark to send your questions to any of us, and we'll try to get back to those. Before I jump into talk about deductions, I want to just kind of give you a big picture overview of what we're doing, what we're trying to, Suzanne and I are trying to do from a content perspective tonight, and also what we're not trying to do. Okay, so you know, this is a total 2 hours, so that's a long time. I'm sure most of y'all been working today, so appreciate you being with us tonight. And but what we're trying to do is just give you kind of an overview of the types of topics that are tested on REG. And obviously, I mean, we can't get into much detail on any of these. Also notice we're not working problems, all right? But I don't want that to be misleading to you. So if you buy the UWorld course, when you actually get into the chapter content and the boot camps and the TBS mastery videos and those types of things, we're working problems all over the place, all right? So you're going to get a lot of experience with not just learning content, but working problems. And then, you know, that $2,099, I mean, that's a great price. And, you know, as I said earlier, I mean, having a CPA, I mean, that is something that's going to be beneficial to you for the rest of your career. And you'll earn that in additional earnings just probably in your first year, okay, after when you're out in the job market after you've earned the CPA. So I'm going to pick up where Suzanne left off. And like I said, I'm going to start talking about, once again, just big picture items about what are the types of adjustments, types of deductions that are actually tested on the exam. So let me move ahead here. So if you get a question about a deduction, the first thing you have to do is you have to say, does this expense relate to a business activity, an investment activity, or a personal activity? Because the rules are different depending on the type of activity. For example, if someone says, can I deduct legal expenses? Well, there's not one answer to that. If the legal expenses relate to a business that you have, then they're going to be deductible. If it relates to an investment activity, it may or may not be deductible. Okay, depends on the circumstances. If it relates to your personal life in general, legal expenses are not deductible, okay, in your personal life. So you can see that first question when you approach a question related to a deduction, the first question you ask yourself, that problem solving skill, is you say, does this relate to a business, investment, or personal activity? I also wanted to mention, I had one question while Suzanne was talking about depth versus breadth. And one of the things about taking REG, specifically REG, is that most of the questions in REG are not what I would call extremely difficult questions. And now that doesn't mean it's an easy exam, okay? What makes REG difficult is in the tax law, there's so many things they can ask you. But once the test writers have decided, for example, they're going to ask a question, say, about medical expenses, about 90% of the time, the question that they ask is usually a basic or medium difficulty level question. Now, there are what I call the 10%ers. All right, there's about 10% of them that are pretty complex problems. But remember, you're shooting for that 75 or higher, right? And so that's why, because that's the approach they're taking. A lot of content, but they don't usually get into a lot of detail in the content. That's why if you have to choose breadth versus depth, you do want to make sure that you get breadth. This slide is just showing you certain types of expenses that are not deductible that have been tested on previous exams. All right. So things you see like life insurance premiums, funeral expenses, disability insurance. I've already mentioned personal expenses in general are not deductible unless there's a specific law that says they are, like charitable contributions. If something's got to be capitalized, obviously you're not deducting it. If it's against public policy, things like bribes, fines, and penalties, and lobbying expenses, okay, those are never deductible. So you want to be real clear on what's non-deductible. Also, if there was no deduction is allowed for any attorney's fees that someone incurred related to a sexual harassment complaint that was filed against them, if the payments are subject to a non-disclosure agreement. Okay, so if the person, in other words, the accuser and the accused, they come to an agreement, and there's usually a payment made, but if it's non-disclosure agreement, that payment's not ever going to be deductible. Remember, entertainment expenses never deductible, and then meals, the general rule for meals is you can only deduct 50% of those. What about expenses related to illegal activities? And a lot of, like, let's say you run an illegal gambling operation. Should you be able to deduct your expenses? A lot of times students would say, no, you shouldn't be able to deduct that because it's against public policy. But remember that the tax law does not tax revenue. The tax law for a business, whether it's legal or illegal, taxes net income. So yes, if you're running an illegal gambling business, you can deduct your business expenses against your income. Note though that if it's an illegal drug business, then it's a different rule. If it's an illegal drug business, there's only one thing you can deduct against your revenue, and that's cost of goods sold. And in all of these situations, for any type of deduction, remember, you've got to have substantiation to deduct that. If you don't have substantiation, it didn't happen. So you cannot deduct it on your tax return. And most drug dealers probably are not keeping detailed substantiation, all right, on their cost of goods sold. Now, where are deductions show? Where do they show up on the Form 1040? See, it's one thing to know that if something is deductible, but when you're studying, you got to also then ask, where is it? If it is deductible, where is it deductible? So a lot of things are deducted for adjusted gross income. Before you get to AGI, those show up on Part 2 of Schedule 1. Itemized deductions actually show up on Schedule A. Now, the first I'm going to kind of briefly mention to you what are some of the more common deductions for AGI. Before I get into that list, I want to remind you that let's say you got someone, a sole proprietor owns their own business, or a farmer has their own farm that they're reporting on Schedule F. They're going to report their revenues and deduct their expenses on Schedule C or Schedule F. And then what are you going to do with that net income? You're going to transfer that over to the Form 1040, and it comes into the taxable income formula before you get to adjusted gross income. So therefore, expenses on Schedule C, those are deductions for AGI because they end up in the tax formula before AGI. Now, some of these other types of things that would show up on Part 2 of Schedule 1, if you're self-employed, you can deduct up to 50% of your self-employment taxes. If you're self-employed, you can usually deduct up to 100% of medical insurance premiums that you're paying for health insurance policy for yourself, your spouse, or your dependents. Alimony, if you can deduct it, is a deduction for AGI. You can only deduct alimony if the divorce was finalized before 2019, right? If it was finalized 2019 or later, no longer deductible. It's important. Now, if it's 2019 or later, the definition of alimony is really not important because it's not deductible anyway. But if it was before 2019, you got to make sure that the alimony meets this tax law, the tax law definition of alimony to make sure it can be deductible. And the one item there that's tested the most is that the payment has to be contingent upon the life of the recipient. So if the alimony agreement said that spouse A has to pay ex-spouse B $2,000 a month for the next 20 years, That's not alimony for tax purposes. Why? Because if that ex-spouse passed away after 13 years, guess what? The former spouse has to keep paying it for 7 more years. They got to pay it for the full 20 years. They'll pay that money into the estate of the deceased. So it should say they'll pay this for 20 years or until the death of the ex-spouse, and then it would actually be alimony. If you make a contribution to an IRA, a traditional IRA, Suzanne mentioned this briefly, those can be deductible up to $7,000 for 2025. That's indexed for inflation. You don't have to memorize that. If you are an active participant, well, let me back up for a second. If 2 conditions are met, then you may not be able to deduct your IRA contribution. Those 2 conditions are: 1, you're an active participant in another qualified retirement plan, and number 2, then your modified AGI is too high. Okay, and this shows you what those how too high is defined in the tax law. But if you meet both those requirements, then you're not able to deduct your IRA contribution. But no, you could have a taxpayer who has $500,000 of AGI, and they could still deduct their IRA contribution. Why? Because they're not an active participant in another qualified retirement plan. Contributions to Roth IRAs are not deductible. But as Suzanne said, but the benefit to those, though, is when distributions come out at retirement, you don't have to pay tax on any of the distribution. Whereas with traditional IRAs, you normally do get a deduction when you put it in, but then when you get the distributions, that's going to be taxable to you. With a traditional IRA, and we're talking about deductions, one question you ask is how much can I contribute? All right, so it's limited to $7,000, but you also have to have at least $7,000 of earned income. And then the second question is can I deduct it? With a Roth IRA, there's only one question. The Roth IRA is can I make a contribution? Because there's no deduction. And note at the last bullet point here, if your AGI is too high, you're actually not even allowed to make a contribution to a Roth IRA. Student loan interest, a lot of you probably are recent grads, and so most of you probably have student loans. That's just the way we go to school these days. The bad news is you got student loans. The good news is your interest on that is deductible up to $2,500 per year as a deduction for AGI. That phases out at higher income levels. Some other adjustments for AGI: if you're a K through 12 educator and you're buying classroom supplies, you can deduct up to $300. If you're married, filing joint, and both spouses are educators, it could be $600. I mentioned a moment ago that in general, personal legal fees are not deductible. Those are one exception to that rule is if it's a discrimination lawsuit. If somebody discriminated against you and you went to court and you won, you actually are able to deduct your attorney's fees as a deduction for AGI. Okay, so now we've finished deductions for AGI. Let's move to itemized deductions, which are on Schedule A. And here I've really only got time just to kind of remind you of what the big categories are that fall on the Schedule A. But medical expenses are deductible as long as they're qualified medical expenses. Here are some types of things that are been on previous exams. You may say, now, how do you know they're on previous exams? I thought the exam was a closed exam. Well, the AICPA actually releases multiple choice questions and a few TBSs every year for each part. The problem is they're really expensive to buy. So it's only major CPA review providers like UWorld who actually has enough resources to buy these, but they buy them. And then folks like me and Suzanne look at those, write up solutions, and put them in the material. So yes, we do see actual questions. And these are some of the types of things that have been tested in the past that are not deductible. Notice cosmetic surgery. If that's because you were injured in an accident and you need facial reconstruction, yes, that's deductible. But if I just decide I wish my nose was smaller and I want to have cosmetic surgery, no, that's not going to be deductible. Real estate taxes. In general, you can deduct real estate taxes that are paid to state and local governments and pay to foreign government. But you can't deduct any, well, not just taxes, not just real estate taxes, taxes in general, state, local, foreign. But if you pay taxes you pay to the federal government related to your individual life, those are not going to be deductible on Schedule A. And then you can deduct, one of the types of taxes that's deductible is real estate taxes. Income taxes are deductible. Some states don't have an income tax. So I live in Alabama now, but I grew up in Tennessee. Tennessee is one of the states that has no state income tax. So they're kind of left out, not getting a deduction. That's why and no matter what states you live in, you can deduct the greater of your sales taxes you pay during the year or your state income tax, but not both. And then under the law, as being tested now, the total amount for state and local taxes cannot exceed $10,000. Here's some common non-deductible taxes been on recent exams. As I mentioned, federal taxes, you can see there, the first two bullet points, not deductible. Social Security, not deductible. And also foreign real property taxes are not deductible. So we've talked about medical, we've talked about taxes. The next category is interest. There's two main categories of interest: mortgage interest and investment interest. You can deduct mortgage interest on up to 2 residences, but the total amount of debt on which you can deduct the interest on, that debt is limited to $750,000. No deduction is allowed for interest you pay on what are known as home equity loans. That's like a second mortgage on a house. Notice the second bullet point here, investment interest. That would be interest related to an investment that you have. So you borrow some money to go buy stocks, or you borrow some money to go buy some raw land that you own just as an investment. The interest you're paying on that is deductible, but it cannot exceed your net investment income. Charitable contributions is the next category. For something to be deductible, it's got to be made to a qualified charitable organization. So, there may be somebody you come across, a coworker, somebody at church, somebody in your community who is raising money for a certain because of certain calamity that's happened to them. There may be a GoFundMe page set up, but if that money's going to individuals, it's not deductible. It's got to be to a qualified charitable organization. If you give away long-term capital gain property that if it was sold, you would produce a long-term capital gain, you can actually deduct the fair market value of that property. For most other property that you contribute, you end up deducting the adjusted basis of the property instead of the fair market value. And then there's several limits that apply to charitable contributions. Your overall contributions, your cash contributions cannot exceed 60% of your adjusted gross income. Other contributions, like property contributions, cannot exceed 50% of AGI. And then notice, kind of in the middle of the slide there, if you do give away long-term capital gain property, that deduction cannot exceed 30% of AGI. Oh, and by the way, what happens if you're limited in how much you can deduct? You can carry that forward, but only for 5 years. Two other deductions categories on Schedule A. One are casualty losses. These are only deductible if they're part of a federally declared disaster area. And you can see the formula at the bottom of the slide there. It's the lower of the fair market value of the property that was, the lower of the decline in the fair market value or that property's basis. And then you subtract out any insurance reimbursements. You subtract out $100 per casualty, and then you subtract out 10% of AGI. And then the final category is something just called other miscellaneous deductions. And this is where gambling expenses fall. And so let's say that I made $20,000 gambling legally, and I incurred $28,000 of expenses or losses gambling. Well, all I can deduct of the $28,000 is $20,000. My deduction's limited to my gambling income, and they go on different parts of the tax return. That $20,000 of gambling income, it shows up in other income, okay, what Suzanne was talking about, the gambling losses show up here on Schedule A as an itemized deduction. And then there is one deduction that is not a deduction for AGI. It's also not an itemized deduction. You've probably heard of this. It's a qualified business income deduction. Fairly complicated deduction. The simple parts of it is that if you have a sole proprietorship or you're a partner in a partnership or a shareholder in an S corporation, your income from those types of businesses, you may be able to get a 20% deduction for that income, meaning you only end up being taxed on 80% of that income. There's several limitations that apply to this. One of these is that if you're in one of these professional services fields and your income is too high, you're not able to get a QBI deduction. And do note accounting's on there, right? Because we're a professional service field. And this is the chart that you use to determine whether your income's too high, and you got to start applying these limitations. There are, so still talking about deductions. In general, under the tax law, you can be cash basis or you can be accrual basis. If you are cash basis, under GAAP, you normally can deduct prepaid expenses, right? Because you're cash basis. But for tax purposes, if you're cash basis, Uncle Sam feels like it's a little bit too easy to manipulate your income by just prepaying a bunch of expenses. So you're only able, even if you're a cash basis, you're only able to deduct prepaid expenses if you meet this rule that you see here. Passive losses, if you have a passive loss, you can only deduct that to the extent that you have passive income. If you own what's known as a vacation home is where you've got a principal residence you live in most of the year, but you got a second home. It could be in the mountains, at the beach, and you do use that for personal use part of the year, but when you're not using it yourself, you do rent it out for part of the year. And so there's a lot of special rules dealing with vacation homes. Okay, so that wraps up chapter 14. So chapter 15 is dealing with, continuing still with this topic of deductions. What are the types of losses? What are the specialized rules that apply to losses to individuals? I mentioned a moment ago that if you have a passive loss, you can only deduct that to the extent of passive income. I also mentioned the limitation on casualty losses. This is just reminding you how you compute a loss. In other words, if you have a sale or disposition of an asset, you take your amount realized from that sale, you subtract out the basis, and that's going to give you a realized gain or a realized loss. You assume that those realized gains and losses are always taxable, go into taxable income, unless you know of a tax rule that says you can't. One of those rules is that if your net capital losses, so you net all your capital gains and losses for the year together, and if that turns out to be a net capital loss, that loss is limited to $3,000 per year. But you can carry forward the amount you couldn't deduct. If you have a hobby, so this is something where you're earning some revenue from an activity, but you're not really fully engaged in it and where you're trying to earn your living from it. It's not a business. If you have a hobby, unfortunately, you're not able to deduct your expenses from your hobby. Now, you might say, what about my revenue that I got? Well, your revenue is going to be taxable, all right? But your expenses are not deductible. And I've already mentioned about gambling losses. Suzanne actually talked about watch sales, okay? So that kind of overlaps in two different chapters there. So I won't go back over that. I mentioned if you have a realized gain or loss, you want to always, you assume it goes into taxable income. One of the most important rules that limits a loss is that if the loss relates to a sale of an item you use in your personal life, that is that is not deductible. Okay. Now, if it's a gain, it is taxable. So if I have a garage sale and I sell this shirt at a loss, it says UWorld on it, right? So it shouldn't be at a loss, right? So people should want to pay a lot of money for that. But if I sell it at a loss, I can't deduct it. Chapter 16 deals with filing status, and with filing status, there's first let's talk. It's really filing status and dependents. And so in the UWorld material, obviously we get into the qualifying child rules and qualifying relative rules in a lot of detail. Here's a summary of those requirements that have to be met for someone to be a qualifying child or to be a qualifying relative. You need to be able to apply those to a fact situation to determine whether or not someone can be a dependent. And why it's important that someone who's your dependent is, like, for example, to be file as head of household, you got to have a dependent. To claim a child tax credit for a child, that child has to be your dependent. And there's lots of other reasons it's important also. Okay, so I'm going to skip over the specific rules for qualifying child and qualifying relative, except to mention that what is really, I think, tested most often for qualifying child is the age test. They have to be less than 19 at the end of the tax year or less than 24 if they're a full-time student. And then also what's tested quite a bit is what is the definition of a child? And you see number 1 here. A definition of a child, I mean, when I've got 2 children, right? My daughter has 3 children. I mean, it's kind of like I know what a child is, but this definition is much broader. It includes brothers and sisters. It also includes grandchildren, and it also includes nieces and nephews. So it's a pretty broad definition. Those are the 2 probably most commonly tested things with that. With qualifying relative, I think that the item that is tested the most is the gross income test. That $5,200 amount you see there is indexed for inflation. So if the person you're trying to claim as a dependent has gross income that exceeds $5,200 for 2025, then they're not going to be your dependent. Now, gross income means taxable income. So if they receive some municipal interest income, that doesn't count against the $5,200. Most people are not taxed on Social Security benefits. And if that's the case, that would not count against the $5,200 either. If you have a situation where the parents of a potential dependent are not married, then the parent who has custody is the one who is able to claim the child as a dependent. That custodial parent can waive the exemption to the other parent by signing this form 8332. Okay, so that's a real quick overview of the filing status of the dependence rules. What about the filing status rules? Well, single is pretty easy, right? If you're married, you're doing married filing joint or married filing separately. Do remember, marital status is always determined on the last day of the year unless your spouse dies during the year. If your spouse dies during the year, then for that year, even though you're unmarried on December 31st, you can still file married filing joint. Where the filing status rules get a little more complicated is 2 areas. One is if your spouse has died, you're married filing joint for that year. For the next 2 years, you can be what's known as a surviving spouse. And if you are a surviving spouse, you can use the married filing joint filing status, the married filing joint rates, and the married filing joint standard deduction. But to be a surviving spouse, you have to be providing over 50% of the cost of maintaining a household for, notice, a dependent child, okay, who is living with you in that household. The other complexity is head of household. A head of household is someone who is single, but the general rule is that they have a dependent they're caring for. So they're providing, once again, more than half the cost of maintaining the household for a dependent who lives with them for more than half the year. And if they're unmarried, that allows them to file as head of household rather than single, which has better tax rates and a better standard deduction. Now, there's 2 exceptions to the head of household rule, the general rule. Notice if you're a child who's allowing someone to be a head of household, that child does not have to be your dependent, but they still have to live in your home. If it's a parent who is a qualifying relative and allowing you to file as head of household, the parent does have to be your dependent, but they don't have to live in your home. Now, if they don't live in your home, you do have to provide more than half the cost of maintaining the household that they do actually live in. Okay, I'm going to come up for air, take a breath, and turn this back over to Suzanne.
All right, thanks, Greg. All right, I have a couple more chapters to do here. My next one is looking at the computation of tax and tax credits. All right, so this is just kind of giving you this overview of how to calculate. All right, so we're going to calculate the taxable income. That skipped quite a few steps there in order to get to taxable income. Times your tax rate, looking at those tax tables. We've got some additional taxes. We have some credits and things that we need to discuss. Right now, we love credits. Credits are a dollar for dollar reduction of our tax liability, so we want to make sure that we get those right. You can have a non-refundable credit or a refundable credit. That non-refundable credit can reduce the liability down to zero, but you're not going to get it back if it's in excess of your liability. On the other hand, that refundable credit does allow you to get a refund for the excess. Right, there's an ordering that we want to follow here. You got your tax liability, and then you want to take your non-refundable credits first, and they allow you to do this, which is advantageous because, again, if that non-refundable credit brought your liability down to zero, all right, and if you had refundable credits, you'd take those next, and you'd still be able to get that refund. So it's important that you understand the ordering of the credits and how to take them to reduce your liability. Here's a couple of examples of some refundable tax credits. The premium tax credit that was dealing with healthcare. People could have chosen to either, go directly to their insurance company to help offset those premiums, or they could wait till the end of the year and possibly claim a credit on their tax return. The earned income credit is enacted for lower income taxpayers and who are seeking employment, and they have employment taxes and income taxes that they have to pay. This credit's based on the IRS tables, and that's another example of a refundable credit. Two partially refundable credits, the child tax credit, again, a very favorable code section. You're allowed a child tax credit of $2,000 per qualifying child under the age of 17. So something to kind of let you know, there aren't always consistent on those age rules. Sometimes you'll see something that says under 17, under 19, under 24, and you do need to be familiar with those different ages. The child tax credit happens to be under age 17. A portion of it is refundable, all right, but that's limited to $1,700. They show you here a calculation for that additional child tax credit. The American Opportunity Tax Credit, the AOTC, is a education credit, again, favorable education credit, $2,500 maximum credit with a 40% of the credit that's refundable. Here's some other characteristics of some common tax credits. We don't have time to go through all of those, but you can see the list there. And some more. All right, so here's our calculation again, just making sure that we're taking those credits out of there after we've calculated our full tax liability, minus our federal income tax withholding and any estimated tax payments maybe that we've made. All right, let's move on to differences between book and taxable income. So our book to tax differences. So yes, for, you're going to be reporting amounts differently for GAAP and for tax, right? And they're both right. So when you're doing financial accounting and you're calculating the income statement and then your balance sheet and so on, that you are following GAAP rules, and that's the right thing to do. And then for tax purposes, we have to follow the Internal Revenue Code. So we report these book to tax differences either on a Schedule M1 or a Schedule M3. You're going to have permanent or temporary differences. All right. Permanent differences don't reverse. Temporary differences are timing differences. And so those will reverse in the future. Schedule M1 versus M3. So an M3 is just really an M1 on steroids, right? It's just really long and complicated. But here's our rules that let us know whether we have to do an M3. All right. So total assets that are greater than or equal to 10 million. Schedule M1, so you have 4 different categories. So you could have expenses that are deducted for book, but they're not deductible for tax. Income that's included for book, but not included for taxable income. Or the reverse, income not included for book, but picked up for tax. Expenses not deducted for book, but are deducted for taxable income. And as you can see, we have a couple of charts here that are identifying some of the permanent and temporary differences. I think entertainment was mentioned earlier by Greg, not deductible, right? For tax purposes, just not deductible. So for book, you would have deducted it, for tax, not deductible. So that's a pretty clear permanent book to tax difference. Here's some more. All right. So if we were looking at, say, for example, bad debt expense, right? So bad debt expense, you can estimate your bad debt expense for our book purposes, but for tax, you have to actually write off that accounts receivable using the direct write-off method or direct charge-off method. And a few more here again, like-kind exchanges is probably an example for book. You're going to recognize that gain. For tax, they're deferred. Just a chart showing you the reconciliation of what that M1 would look like. That middle box there that you can see, net income. We're always starting with net income per books and working our way down to taxable income. Now you might see some TBSs, a task-based simulation that's actually having you walk through, all right, to do the calculation from book income to taxable income, or they're just giving you a trial balance and you've got to determine what taxable income is from that. So a couple different ways that they could present information to you in this regard. And then finally here, you can see that this is what a Schedule M1 looks like, right? So we're starting off with book and working our way down. All right. Chapter 19 is dealing with C corporations. So this has a little bit more information to it. Again, won't be able to go through all of the characteristics in detail, but we do in our boot camps and certainly within the UWorld information that you can read through: limited liability, independent life, ease of transfer, taxation, centralized management. Here's our formula, right, for corporations. It should look familiar to you. You got gross income minus your ordinary deductions before special deductions and before the charitable contribution deduction. We will briefly talk about charitable deduction and DRD, dividends received deduction. We have a flat 21% rate right now. All right, so cash versus accrual. So typically the following can't use the cash method of accounting: your regular C Corps, partnerships that have regular C Corps as partners, and tax shelters. However, you can use the cash method of accounting if the annual gross receipts for the last 3 years don't exceed 31 million. That is a number that changes for inflation every year, so you don't need to have that memorized. A couple of things with periods and methods. This is looking at the income side of things, and you can see cash method versus accrual method. The general rule: cash method, income when received. You can see that all the way down, right? No matter what it is, income when cash received. The accrual method, on the other hand, all events test met, and you can determine it with reasonable accuracy that you would include that in income. Any advance payments received for interest income or rent revenue. Income when cash received under cash method and accrual. Any advance payments for services, income when cash received for the cash method. Income when received unless elect to defer, great, but you also have to defer it for financial reporting purposes as well. Let's look at the expenses. So prepaid expenses, got to be careful there. Under the cash method, you are allowed an immediate deduction as long as the benefit for that expense does not extend beyond the earlier of 12 months after that benefit began, or the end of the next year in which that payment was made. Now, if that 12-month rule is not met, then those expenses need to be amortized. One thing I wanted to point out is prepaid interest. Prepaid interest always has to be amortized over the life of the loan. All right. Compensation expense, deductible if accrued during the tax year and paid within 2.5 months of the year end. So decisions could be made at the end of a year. Let's just say it's a calendar year. So the board of directors get together and they decide on December 15th, but it's not going to get paid out, say, until January 31st, right? And it's a calendar year end. We're fine. We would be able to take that. Up to $1 million of compensation expense for certain covered employees is permitted. Couple other things about deductions. I mentioned the bad debts, right? So for tax purposes, we use the direct write-off method. We have to specifically identify an accounts receivable that we can't collect. Warranty costs can't be claimed until repairs are actually made. And lawsuits, the loss is not deducted until that all events test has been met. Some other ones, research and experimental or R&D developmental expenses incurred after 2021 must be amortized over 60 months under current law that you are being tested on until July 1st. Some non-deductible costs, fines, penalties, political contributions. Greg mentioned entertainment before, and 50% of meals. So there's our formula again. Next slide. DRD, dividends received deduction. So you're a corporation who owns stock in another corporation, and that second corporation pays dividends, right? So to help mitigate some triple taxation, because you've got the earnings taxed on corporation B, who issues a dividend, right, to corporation A, who then includes it in income, who then issues a dividend to their shareholders. So you could have triple taxation. So the DRD is helping to mitigate that. How much you get to take as a dividends received deduction depends on your ownership. Next slide. All right, here's our holding period that you got to meet, 46-day holding period in order to get the DRD. Next. Here's, now this you got to memorize, guys. All right, because this is not subject to inflation, right? So if you own less than 20%, the allowed DRD is 50%. If it's greater than or equal to 20%, but less than 80, you have a 65% DRD. Greater than or equal to 80%, 100% DRD. All right, yeah, go ahead and put up all those steps. So we've listed the steps. I don't have time to go through them, but UWorld material is very detailed, lots of questions on how to calculate that dividends received deduction. Charitable contributions. Now, this slide does say charitable contributions for individual taxpayers, but a lot of this is the same for corporations. So I just wanted you to know that we have a lot of detail that's put in here, depending on the type of contribution that you're making. All right, on how to treat that and what that allowable deduction would look like. Next slide. For corporations, though, all right, that deduction is going to be the lesser of the amount that was actually contributed to the qualified charitable organization, or 10% of corporate taxable income before the charitable contribution itself, before any NOL or capital loss carryback, and before the dividends received deduction. That's current law that would be tested until July 1st of 2026. Capital gains and losses. So for corporations, it's different than individuals. So again, you could have 10 transactions, the capital transactions that corporation has. You net them, right? If you have, net, our capital losses can offset our capital gains and can bring it down to zero, right? But if you have a net capital loss, you're allowed to carry it back 3 years, carry it forward 5 years. They like to ask that one in a multiple choice question. So carry back 3, carry forward 5. That applies to corporations, not individuals. Net operating losses, much easier calculation for corporations, because you're just looking at the Form 1120, and if you have a loss at the bottom, that's your NOL, right? So it depends on when that occurred as to whether you could carry it back, carry it forward, or whether you had any limitations. After 2020, you can carry forward indefinitely, but that deduction is equal to 80% of taxable income before the NOL. All right.
Okay,
all right,
Suzanne. So one of the
back
things
to
y'all may have picked up on, all right, when Suzanne got to chapter 18, she started talking about corporations. Some folks have some candidates for the exam have a misconception that REG is individual and TCP is business entities. That's not the case. As you can see, we're just covering REG here tonight. So REG does test the more basic fundamental income tax laws relating to C Corps, S Corps, partnerships, LLCs, and even a little bit on tax exempt organizations. And then when you get to TCP, TCP also does test some individual topics. So for example, it tests alternative minimum tax. It tests like-kind exchanges. It tests stock options. So both REG and TCP both cover some individual topics and some business entities. So in just the next 8 minutes or so, I'm just going to show you the types of things that are being tested related to flow-through entities. like S corps and partnerships. To be an S corp is incorporated under state law, just like a C corp is. So what makes it an S corp is it has to make an election to be an S corp, and to be an S corporation, it has to actually qualify, it has to meet the appropriate requirements. Now, the nice thing about S corps and partnerships and LLCs is they have single taxation. C corporations have double taxation. The income is taxed when it's earned and report on the 1120 at that 21% tax rate. But then when dividends are paid to the shareholder, it's taxed a second time. S corporations and partnerships in general, they don't pay taxes. The income flows down to the owners and goes on the owner's tax return, and therefore you only have single taxation. Here's just some of these requirements that you have to meet to be an eligible S corp. You cannot have more than 100 shareholders. Shareholders in general need to be individuals or certain estates of trust. Shareholders have to be U.S. residents or citizens. Got to be a domestic corporation, and you can only have one class of stock. So if you violate any of those, you're not going to be able to be an S corp. When you're actually looking at the 100 shareholder requirement, husbands and wives are treated as one shareholder. Notice banks and insurance companies, they're just not eligible ever to make a S corporation election. If you're making the S corporation election, it has to be unanimous. So if you've got 8 shareholders in a C corp and you want to be a S corp and 7 vote yes and 1 votes no, you're not going to be an S corporation. All right. And then this form that you file to make the election, Form 2553, it is due by the 15th day of the 3rd month of the tax year for the election to be effective for that entire year. So if it's a calendar year corporation, as long as they make the election by March 15th of 2026, they can make it retroactive to January 1st of 2026. On the other hand, if they don't make it until after March 15th of 2026, when will it be effective? January 1st of 2027, okay, the next tax year. If you are an S corporation and you terminate the S corporation election, then you got to wait 5 years before you can re-elect S corporation status. This shows, I mentioned that the income from the S corporations and partnerships flow through to the owners, to the shareholders for an S corp. When it flows through 2 different routes. Okay, on the right-hand side, you have separately stated items. These are items that might impact 2 shareholders' personal tax returns in different ways. So things like investment income, charitable contributions, net capital gains, net Section 1231 losses, all those are separately stated. Everything else that's not separately stated goes into the left-hand side there, non-separately stated items. Those are actually reported on page 1 of the 1120S. And the net of those has a very specific name, okay? It's called ordinary business net income or loss. When items flow through from an S corporation or a partnership, they retain their tax status, their tax character. So for example, if it's a charitable contribution that the S corporation made, when it flows through to the shareholder, it's still a charitable contribution. And an individual shareholder would take their share of that and put it over on Schedule A as an itemized deduction. Notice C corps don't work that way. When C corps have all their income and deductions on the 1120, it just all gets mixed together, and it all really just becomes ordinary income and ordinary deductions. So here's a list of the more common type of separately stated items that you'd be likely to see on the exam. This is actually a copy of Schedule K from the Form 1120S. This is where those separately stated items on the partnership return, those start on line 2 and go to the end of the form. What's on line 1? Line 1 is that ordinary business income or loss that is the net of the non-separately stated items from page 1, and it gets carried over here. So here's some examples of the types of things that are non-separately stated. One of these they love to test is recapture. Because some students kind of have in their mind that if something's complicated, it's probably going to be separately stated. And recapture is pretty complicated, Section 1245 recapture. But notice Section 1245 recapture, it's just ordinary income. So it does end up being non-separately stated. And this shows what page 1 of the 1120S looks like, where those non-separately stated items go. When all these items flow down, the separately stated and the non-separately stated, they do, the income and expenses obviously impact the owner's tax return, but they also can increase their basis in their stock by the income items that flow through to them. And then they decrease it for the deductions that flow through to them. And this is a more detailed formula that shows how basis is computed for an S corporation shareholder that we go over in a lot of detail in the UWorld material. An S corporation shareholder also has something known as debt basis. I mentioned earlier tonight that you can only deduct losses on your tax return, say from a partnership or S corp, to the extent that you have basis in your stock. Well, if you have debt basis, you can also deduct those losses to the extent of debt basis. There's something that an S corporation has known as the accumulated adjustments account. That represents the cumulative earnings that the S corporation has had while it's been an S corp that has never been distributed. So it's like retained earnings for GAAP purposes. It's very similar to that. This shows you how you would compute the accumulated adjustments account. And then when you're dealing with business entities, you always need to know what's going to be the tax consequences of distributions made from the entity to the owner. And this is showing you that for an S corporation, the formula is different depending on whether the S corporation has any earnings and profits. It would only have earnings and profits if it used to be a C corporation before it made the S election. But if it has earnings and profits, it's a 4-step formula. If it doesn't have earnings and profits, you actually only have to use steps 4 and 5. Only 2 steps to determine the tax consequences of the distribution. Okay, just a couple of things about partnerships. There's lots of different types of partnerships: general partnerships, LLCs, limited partnerships. The flow-through rules that I just talked about for S corps, separately stated and non-separately stated, those are very similar. Basically, it's the same rules as you see this chart here that you have for partnerships. And then if you see the word guarantee payment, a guarantee payment is something that is it's basically where you're a partner and you're rendering services and you're getting paid something similar to a salary, but for partnerships you don't call it a salary. You call it a guarantee payment. And Suzanne actually went over that in her first segment tonight. This is how you compute a partner's basis and their partnership interest. It's very similar to the S corporation shareholders basis, with one big exception. If you're a partner, you do get to increase your basis for your share of partnership debt, whereas S corporation shareholders are not allowed to do that. Let's see here. LLCs, you see a lot of limited liability companies. If you're working in a public accounting firm, probably most of your clients are LLCs rather than partnerships. But most of the rules for LLCs are the same as the rules for partnerships. Okay, so there's very few differences in those rules. And I want to pull up here, I want to pull up the last slide to wrap this up before we see if UWorld has anything else to share. But to me, this right here is the most important characteristic you need to do to pass the exam. You don't have to be the smartest person in the room, all right? But you got to be somebody who's willing to work hard, and you got to work smart, and it takes perseverance, all right? It's a major journey, and as we've said several times tonight, you got to do a little bit every day and just persevere. Keep your head down, keep focused on the go, don't have distractions, persevere, and you're going to pass that exam.
Greg, before we wind up, Sarah, I wanted to ask a question to Greg that was posted in the chat box here. So what if we had somebody who wanted to take TCP before REG and do it before July 1st? I had recommended taking REG before TCP because there's so much information that while you're studying for REG is going to help you with the material that you're learning for TCP. Just wanted to see if you had a different opinion on that.
No, I agree with that. And, you know, there's certain things listed like that are in the blueprint for reg, like say filing status and dependents. They're not going to come back and test those again in TCP. But the general rules about what's income, what's deductions, how do you compute property transactions, you got to know that for reg. That's the fundamentals that they build on TCP. So like Suzanne said, there's a lot of carryover from reg to TCP. And
do we know if a student can take TCP
they can.
before reg? Yeah,
they can. Okay, they can. And I've actually known one person who did it, and they passed them both. But but the question was, do we recommend it? No, we don't recommend it.
Okay. All right. Just wanted to clarify. Thank you.
Sarah?
Are we going? You want to advance to the next slide, or?
Oh, I'm sorry. No,
that's right.
There we go.
Yep. Thank you both so much. This has been nothing short of awesome. Really enjoyed all of the great information that you've had to share. Just a quick announcement about our next session coming up here. You can register here. It's going to be for FAR lecture series from one of our instructors, our very famous instructor, Peter Olinto. Will be walking everybody through FAR toughest topics. We have these, one coming up in, looks like leases is coming up at the end of April. So be sure to sign up and register for that. And then, yeah, just want to thank everybody for attending. There are 2 ways to get the discount for tonight, for those of you that have attended tonight, to purchase the review course. I do offer complimentary advising sessions. If you'd like to meet with me individually to walk through your classes, set up a test order plan, to walk through setting up your study plan, all of it, my contact information is below or is on the slide here. And I would welcome and love the opportunity to meet with any of you and help you get certified. Okay. Thank you so much, everybody.
All right. Thank you, everybody, for taking time out of your night.
Good luck.